Welcome back to my class, The Psychology of FinTech. Here, I'm going to talk about why should we care about EMH so much, right? 5 reasons we're going to talk about it. And then, what are those scenarios that support EMH? 3 scenarios I'm going to talk about it. This, you may say, oh, why don't you talk about the payment technologies or some blockchains first of all, because this is FinTech class. But wait a minute, this is market psychology class, just in the name of FinTech, okay? And then the market, we have to, every now and then, until now, you must have learned the traditional finances from neoclassical point of view, and you must have been flooded with those mathematical formulas that you have to memorize for testing and then things like that, and forget about what the heck you did before. And then when you try to invest actively in the stock market or passively in the market, right? You're driven not by the theory that you learned in the finance class before, but by the psychology that you feel at the moment of investment. Fear of missing out. Oh, everybody else is making money, so I should jump into the stock market. And then, oh, I should sell off everything because it seems like the price is going to go further down, and then everybody is selling it together. All this kind of market psychology drives you like crazy. And if you think about the FinTech, the purpose of it, financial democratization, what did I say before? You are not able to help those poor people using FinTech if you believe that you can give high quality information. You can help those poor people using FinTech by advising and taking care of their psychology. Okay? You need to understand those market psychology, investor psychology much more. And the thing is, if you watch this finance not the finance news, right? Financial news like CNBC or Bloomberg or anything in the YouTube, right? Every now and then, you will face much more news talking about the sentiment and psychology of the market rather than the pure information like cash flow and risk of the companies, right? You must have heard about the market sentiment drove the price upward or downward, certain percentage. You must not have heard somebody say market investor economy was driving the price up or down. They always say investor psychology. Okay, so that's one important reason we should focus much more on market psychology. But at the same time, we have to have a strong skeleton, our starting point, which is the efficient market hypothesis. And this is non-trivial because it has economic theory behind it. Economic theory, very coherent set of theories are there in EMH. So we need to first build up our understanding about what we mean by EMH. Why do we have to, why should we care about EMH first? And then we'll move to when does it break down? Okay, that's next class's portion and going down the road. So wait for that. Now, talking enough about it. What is that? Why is this EMH so important? Well, we have 5 aspects of reasons. 5 reasons why. Social planner's perspective, it is important, EMH, right? Second, who wins and loses in the investment? For that part, for fair game, the market has to be efficient. And number 3, risk sharing among investors, right? Different people have different degrees of risk aversion. Let's share the risk proportionately to your risk aversion. For that part, you need EMH. And then number 4, in corporate finance setting, incentive giving is very important. And the most popular form of incentive is stock ownership or stock options, like call option. In that respect, you have to make sure the market is efficient. The price should be reflecting the information correctly. Otherwise, all those incentives will be screwing up the economy. Number 5, resource allocation among divisions within a company. So investment decisions within a company, okay? Allocation of your budget, okay, capital budgeting. You need to have precise information, and that information should be summarized nicely in the price. Otherwise, your investment decision in your company will be screwed up. So in that 5 aspects, all in all, you will realize that a whole set of economic theories that support our market in the global market is based on the assumption, the hypothesis that EMH holds true. Okay? What if it breaks down? So let's go. Social planners. Well, it goes back to Adam Smith, classical economics. Right. Chicago, Minnesota, Carnegie Mellon. Did I say neoclassical? New classical economics, but they are the descendants of Adam Smith. I was fortunate enough to go and do my research seminar at the University of Edinburgh before. Thanks to Professor Eshragi and then Professor Wenshan Wu. And so here in what they say, think about the social planners, right? The resource allocation in an economy is an important thing, right? And then the market takes care of it in capitalist market or world, right? Whereas in North Korea, our neighboring country above, right? Or communist countries, the social planners, Kim Jong-un is the social planner, the single individual, right? Hope and pray that he will be generous to you and allocating all those resources and food to you, food rationing and things like that, okay? The thing is, it's erroneous in that communist countries, right? Pure elite will deliver all this kind of resource allocation correctly, ideally, hope and pray that that happens. That's what Marx said, Karl Marx said. But good luck, it did not happen in Soviet Union in their history of 70 years, right? We've seen enough of that. Adam Smith, on the other hand, right, in classical economics, said this, right? Proposed that the price mechanism in a competitive market is the invisible hand that allocates the resource most efficiently, as long as you abide by the rule in the market, okay? And then you behave in your self-centered manner, right? Selfish ways, just abide by the rule and transact, buy and sell, right? Negotiate in the market, and naturally an equilibrium will happen. Supply meets demand, and the price and quantity is determined, and then everybody's happy. Okay, participants behave rationally in a selfish manner. Don't worry, be happy. The invisible hand will take care of you naturally, right? So that was the idea. And social planning perspective, right? If correct, which means if the price reflects all this information, the price gives useful information about expected economic growth, discount rates, and volatility or risk, so that everything will be, optimally solved. Pareto optimality will happen, and then resource allocation will be most efficient. Bad prices, which means if the price does not reflect the information correctly, then it will compromise business and consumer planning for the whole country. So what I show you over here is, stock market index like Dow Jones Industrial Average is a predictor of what's coming up in the real economy, real GDP growth rate. They go in tandem, and moreover, the stock market is a thermometer, so that you can look at the stock price index and estimate or gauge how the economy is doing. Okay, what's coming up, you can see it in the stock price, and that is under the assumption that the market is efficient. Okay, from the social planner's perspective, this price is very informative and very useful. That's what I'm saying in the first point. Second point, in investment game, who wins and who loses, right? Market has to be a fair game. If prices are right, then average investors cannot really make a mistake as long as they stay diversified. Higher risk will be compensated with higher expected return, not realized return. One should be aware, right? But if prices are not right, not reflecting the information, unsophisticated traders like you and me, individual investors, right? We say in Korea, 개미들 or ants, right? Those ants, spiders and ants, okay? In America, you say apes, right? Individual investors. We are not sophisticated, so that we get sucked up by this, institutional investors or smart money, right? Unsophisticated investors will lose money, okay, because the market is not efficient. Yeah. And then more generally, irrational prices can arbitrarily affect allocation of wealth in the economy. Okay. Number 3 point, allocation of risk across investors, risk sharing, right? If the market is efficient, prices facilitate efficient risk sharing among investors because price is informative, right? And then the return data that you got should be correct, right? Going into the future, you can use it, and then you can assess and then risk sharing in portfolio theory setting and then CAPM setting should hold true. But if the price is not efficient, then it's going to be harder to quantify risk because the price is wrong. Then the return may not be that informative in estimating the true risk of the companies, and then harder to quantify and harder to make good portfolio decisions. And then this EMH turns out to be one of the key assumptions for capital asset pricing model that you learned before. And if investors are unsophisticated and irrational, they may not diversify properly. So that brings a whole lot of trouble for us. Then the number 4 point is about corporate governance, right? Corporate governance, what is that about? Well, think about this question. What ESG, right, is hot in fashion right these days. What do we mean when we say a company has strong corporate governance, right? For example, LG Chemical over the past year. If you look at, for Korean students, you must be familiar. One of the top 5 companies in terms of market size, market cap, are LG Chemical, and LG Energy Solution. Okay, and LG Chem used to be the number 3 company in Korea, and now and then last year end they spun off, carved out their rechargeable battery division in the name of LG Energy Solution. And guess what happened to the shareholders, right? Screwed up, right? All these values, the wealth transfer unjustifiably happened from LG Chem to LG, Energy Solution. Does LG Chem, does it have strong governance, corporate governance? That's one question. And then Amazon.com news, I'm going to give it to you in the website, and think about, their corporate governance. Is it strong or not? Okay, think about it. What is stock buyback they discuss in Amazon, right? So corporate governance, what is that about? Well, Andre Schleifer at Harvard Business School, he says, it's about how to get my money back as a shareholder. My precious money as a shareholder. I want to get it back instead of sucked up by somebody else, right? How strongly can you claim as a shareholder? That's what the governance is about. It's about check and balance. Last class, I told you about the importance of check and balance in different sense, right? in fintech development and technological innovation, or the selling your new products, developing new products, is it a good one or not? You need to go through some checks and balances in that setting. Here, it's about the decision making of the CEOs, screwing up the shareholders versus not. Okay, can you prevent that? Can you prevent such sucking up of the blood? Right. That's about corporate governance. Right. Why do we have these governance problems? One of the important aspects of ESG, by the way, governance, right? Well, you must have learned about it. It gets problematic once you have a separation of ownership and control. If there's no separation of ownership and control, which means you are the CEO and then you are the only shareholder of your company, then you have no problem of governance, at least for this kind of shareholder versus CEO's governance setting. You have no problem, because if you screw up your company, then you will screw up yourself. So nobody will be unhappy, right? Only your family will be unhappy, right? But as a company gets bigger, okay, you have to separate the ownership sometimes from the control, so that there will be millions of shareholders owning Samsung Electronics, and then the decision maker, the CEO, is not you. One representative guy will do it. Okay? Then the question becomes the CEO. What's his or her purpose, objective? He or she wants to maximize her utility or his utility. We call the CEOs an agent working for the shareholders. And the shareholders, we call them principal. What's the objective of the shareholders? We want to maximize shareholder value. Of course, we ourselves cannot maximize it directly, but we hope and pray the CEO will, work for us, right? So that he or she will maximize the shareholder value. Okay, but the thing is, maximizing his utility can be anything, okay? You never know what he or she is going to do behind the closed door in the corner office, whatever he or she does. In the airplane, the private jet that she rides on or he rides on, you never know what's going to happen over there, right? The destination where he or she goes, can you control them? Okay? Maximizing his or her utility. If the CEO, wants to maximize the shareholder value, just like what you want to as a shareholder, then you're lucky. That's good. But most of the time, they want to relax. They want to relax, live a happy life with minimum degree of pains or efforts, and maximize their gains somehow. That may hurt the shareholders' values, right? You have something called agency problem that you must have learned in your economics basics, right? And then the problem, agency problem, how can we resolve? Okay, how can we solve this agency problem? You need incentive alignment, right? How can we motivate the CEOs to work hard for us by giving economic incentive? Okay, here is a separation point between the psychologist and the economist, right? The economists say everybody is rational and tries to maximize utility. In that sense, how can the best way to make a certain person work hard for us is by giving incentive, right? Like Robinson Crusoe's, right? Friday kind of issues, right? Psychologists would say, well, intrinsic motivation is the most long-lasting drive that the person can work hard. Okay, so that self-realization has to be in line with, our shareholders' purpose. That's the psychologist approach. But the psychologist approach has its problem. Okay, realistically, how do you know the self-realization objective of this CEO? Okay, does he or she truly disclose it? No, never. So that's a realistic problem. But economics, it's clear and simple. The incentive, money, man, easy way of saying it, money, give me more money, right? But by giving what? Not just a simple cash, but share ownership or stock option, call option. Call option, what the heck is that? It's the right to buy the stock at a certain strike price, a fixed price, regardless of the price movement. Okay, if you have seen the price movement in investing.com or by investing yourselves in your lives, then you must be familiar with this movement of price in real time. Wouldn't it be good if you could buy the stock at a lower fixed price called the strike price, whereas the price is way higher than the your strike price? Call option is for you. If the CEO has this call option, he has or she has every reason to work hard to make this price go up much higher than this strike price of the call option. So that's a strong economic incentive. Okay? But that's under the premise that the price really reflects the information that the CEO is working hard and working smart enough. Okay? What if it does not? What if the price does not reflect the information? Would it have incentive effect? Is a serious question. The last line is one example from my friend who worked in KD Media, a listed company in Kosdaq market before. And he was a CEO over there and said, you know, Andy, right? That was a time when the Gangnam Style of Psy, the rapper, was heavily popular. And then the KD Media was experiencing the stock market bubble associated with Gangnam Style over here because KD Media long time ago made an album jacket to the rapper Psy. So whatever related to Psy was hot in fashion, and then the people started to buy the stocks together with it. The stock price was in a bubble, not efficient. What was the problem that this guy suffered in his company? He said, my employees, they are only looking at the stock price chart and then try to time the market. And when should I sell the stock? Right? Instead of working hard, right? So no incentive effect if your stock is in the bubble. That is a serious problem. Okay? Number 4 point, corporate governance, I'm talking about it. And then, so incentive heavily depends on EMH, right? Number 5 point is the allocation of capital across firms. Well, this is about capital budgeting. At the end of every year, the CEOs have to decide about the budget allocation. The companies may have multiple divisions. For example, Hyundai Motors, right? Hyundai Motors, they have conventional combustion engine car divisions, right? An electric car division, and then hydrogen car divisions. 3 divisions and maybe more, credit card divisions maybe. And at the end of the year, fiscal year, the CEO has to decide which division should get more funding for future business development. Of course, if they have infinite amount of money, they don't have to worry about it, but the resource is scarce. Okay? The scarcity drives us to make an economic decision. That's economics 101, right? So, given the limited budget, there will be a fight among these division heads, right? And everyone in these division heads will fight for their budget to feed their subordinates and then their divisions and then expand their own businesses, right? But for CEO's perspective, he or she has to make a rational decision instead of giving money to anyone he loves more, right? No nepotism, please. So what should be the rule of investment decision, the allocation of this budget? Well, typically they will look at such metric as Tobin's Q. Okay, Tobin's Q. What is that about? It's close to the concept I told you before, the price to book ratio, PB ratio. In what sense? Well, you look at the numerator and denominator. This numerator is the market value of invested capital, and then the denominator is the replacement cost of these invested capital. What the heck do you mean by invested capital? You may say it, but what I'm saying is this. You look at the balance sheet again, right? It's essentially, this is the way I understand it, right? Balance sheet, it's not bullshit. Asset, liability, and equity, right? Invested capital is about this asset side of it, okay? It's about for your day-to-day business, how much you invested, okay? Invested money, invested capital, that's sitting on your left-hand side of your balance sheet, right? Historically, how much did you invest for your day-to-day business, your factory, your land, and your machineries, and things like that, and inventory as well? That's invested capital, right? What goes into your denominator is historical value of that, or even the replacement cost, which will be much smaller than what you already invested, because there is depreciation associated with it. Okay, but anyway, largely speaking, roughly speaking, that's book value of this left-hand side of your balance sheet. That's your denominator. Numerator is the market value of this left-hand side of your balance sheet. Your business, right? Invested capital, your factories and your machineries and your patents and your things like, to produce things, right? To produce your goods and services. In the market today, how much are the investors evaluating your invested capital today? Okay, that's your numerator, market value of invested capital. Oh, today, if I sell it in the market, it will be, valued as much, like this. Market value of invested capital. Okay, isn't it replacement cost? No, this one is more like a fire sale. Oh, I have to sell it quickly in a rush. But this one in the numerator is more like, if I make a fair deal, right? And then accepting or making a negotiation fairly enough, how much can I sell it for? That's the idea. And then the large part of the market value of invested capital would come from the market value of equity, which is about your market cap, or 시가총액 in Korean terminology. The stock price times the number of shares outstanding. That's a significant part of the market value of invested capital. All in all, this Tobin's Q tells you about, for each dollar of assets that you invested in the past, how much are the investors evaluating it? You want it to be more than one, because if it is lower than one, you feel unhappy as a shareholder. Why did I invest in the past, given that this is not evaluated as much, but not welcomed in the market? Number two, this has an implication for the capital budgeting, or this budget allocation decision, right? Which division should deserve more capital allocation? Well, you want to invest more to the division that is welcomed in the market today, which means Tobin's Q, division by division. Combustion engine division, they may have their own Tobin's Q. And then electric car divisions, they may have their own Tobin's Q. Hydrogen car divisions, they may have their own Tobin's Q. Compare these and then give more money to the divisions with higher Q, because that is welcomed more in the market today. It is much more promising. It's a growth part. If the Q is lower than 1, that's somewhere you have to divest, right? Disinvest. You have to pull out from that division. That's the rule, okay? Typical rule. Following, the US state, taking the market, mechanism into your company, okay? But your decision rule of using Tobin's Q kind of metric heavily depends on the premise that the market is efficient. Is today's price in the market, is it really correctly reflecting all those information? If not, then you are in trouble. You cannot use Tobin's Q. The metric of your decision making is not valid. So that is a whole lot of problem. Yeah, so this is a discussion that I tell you already told you. So go ahead and read it. Right. So that's that. Next video, I'm going to talk about the scenarios that justifies these efficient market hypotheses. Here today, in this video, I gave you 5 different reasons why EMH is so much important. What you have to realize is that EMH has a reason why it is treated so preciously in economics discipline. Goes to everywhere, okay? It's a fundamental concept, so that if it breaks down, every part of economic theory gets questioned, okay? So we have every reason to believe in EMH, right, as an economist. But in reality, is the market really efficient? There goes a challenge. Serious problem. So thanks for watching.